Out of every dollar that exists today, 25% of them were printed in the last year, and that number is still rising. And while most other currencies haven't increased their money supply to the same degree as the US dollar, pretty much the same thing has happened all across the world. Now, there's no shortage of people saying that hyperinflation is right around the corner, and we should all prepare for the failure of fiat currency. And there's no shortage of people preaching modern monetary theory and claiming that the days of hyperinflation are gone forever. But the reality is probably somewhere in the middle. And I think it's worth establishing the facts behind what's happened so far, what precedents there are, and why things might be different this time. So today, we're going to talk about quantitative easing, the money supply, and whether or not hyperinflation is actually on the way. So first, we ought to actually establish what inflation and hyperinflation is, as that's something most YouTubers seem to gloss over. Now, put simply, inflation is just the increase in prices of goods and services over time. Now, a government aims for an inflation rate of around 2% each year, as it helps to promote spending and investment in the economy while not leading to runaway prices. Hyperinflation is when the prices of goods rise by over 50% in a year, and it's pretty much never a good thing. Businesses go bankrupt, people's jobs disappear, and savings shrink away into nothing. The only positive is that debt disappears as well, something that some governments have tried to take advantage of, although it never really works out well. So why are some people afraid of hyperinflation today? Well, as a result of the pandemic and the lockdowns, governments around the world have tried to counteract the impending recessions by printing money. Different governments have done this in different ways. The US has literally just created money, sent it to its citizens, hoping that they will choose to spend it to stimulate the economy. Other countries like the UK have been offering to pay the salaries of people whose jobs have been suspended because of the lockdowns in a scheme known as furlough. What's important isn't really the how, but the how much. And that's where 2020 has been different to everywhere else. In the 2008 recession, $700 billion was created essentially out of thin air and inserted into the American economy via QE. Over the course of the last year, $4.2 trillion has been printed, over 6 times as much as last time. In the UK, the 2008 recession warranted QE worth £350 billion, while so far in 2020, the UK has printed $800 billion, a staggering amount considering the UK's relatively small size. Even though 2020's figures dwarf those from the last decade, at the time, the QE going on post-2008 was absolutely huge and unprecedented, and there were thousands of people preaching the dangers of hyperinflation then, just as they are now. So what happened to the inflation rate after this quantitative easing, and why didn't we have hyperinflation then? Well, according to the CPI, the Consumer Price Index, which is the most common measure of inflation, the United States averaged a 2% inflation rate, which is exactly what it was aiming for. It saw a high of around 3% in 2011 and a low of 0.1% in 2015. In the UK and other major developed economies, the situation was pretty much the same, with CPI inflation averaging between 1 and 2%. So with all this money being forced into our economies, why has inflation remained so low? Well, it comes down to mainly where that money ends up and the way in which CPI and inflation is measured. Firstly, CPI is essentially measuring the average prices of the things that most people, normal people, spend money on. These products are then weighted according to how expensive they are, how frequently people buy them, and how many people buy them. That means that the costs of milk, bread, and eggs are very heavily weighted, as almost every household buys them regularly, while houses and car prices are not, as people very rarely buy these goods outright and almost always pay monthly through leases or mortgages. Investments into stocks and shares or collectible assets like watches or Pokemon cards are also severely underrepresented in the CPI, as they aren't deemed normal household spending. This means that asset inflation, which you've probably heard of quite a lot recently, can soar extremely high without having any real effect on the government's inflation figures, something that's happening worldwide right now. Average house prices in the US have risen from a low of just over $200,000 to $346,000 in 2020, an increase of over 66% in 10 years, outstripping official inflation figures by 55%. In the UK, the average house has increased from £155,000 to £250,000 during the same period, an increase of 61%. Now, you might expect a rise in house prices to be measured in the CPI, but rent has little to no correlation to house prices, and due to the fact that interest rates have sat at or below 1% for the entire decade, mortgage payments haven't really increased either. What's even more shocking is that the S&P 500, the most widely used investment ETF in the world, has quadrupled over the last 10 years, averaging an increase of 11% every year. This is what people are referring to when they talk about asset inflation, and why asset inflation can go unnoticed by most people in the economy. But why do we see inflation in our asset prices, but not in our goods and services? Well, it comes down to where the money that we printed goes, and where it went following the 2008 recession. Unlike the recent stimulus checks during the lockdown, the money printed by QE went to the banks in order to be lent out to businesses to invest in themselves and to people to buy themselves homes or cars. This meant that the printed money literally never reached the consumer goods and services that make up the CPI. No one who kept their job was sent a check from the government to buy clothes, so those clothes never saw upward pressure from increased demand that would cause runaway inflation. As a result, asset prices increased while the governments kept reporting low inflation numbers. So is the same thing going to happen today, or will consumer goods be impacted by inflation this time? Well, right off the bat, a lot of the money that's being sent to people's bank accounts will end up being spent on everyday items, which could force prices up. This isn't, however, a sure thing, as the money spent on everyday items is mostly replacing lost income, so the total money in regular circulation isn't increasing by as much as you might think. To add to that, those who have held on to their jobs are getting their stimulus checks on top of their income, and in states or countries where the shops and bars are closed, they literally have nowhere to spend their money. So they invest it in a new home for themselves, maybe a rental property, or cryptocurrencies, or just in the stock market. This is the reason asset inflation has gone insane over the last year, with house prices seemingly increasing by 2 to 3% every month, with the S&P 500 up 50% year on year, and Bitcoin up 1,000% over the year. And this is the main reason some people think that hyperinflation is a far-flung fantasy. They believe that most of this newly printed money is never going to impact consumer goods and services, as it's going to sit in asset classes that have low levels of velocity. Others say that this increase in the money supply will at some point leak into the real economy and will cause runaway demand pull inflation. To be perfectly honest, I don't think that hyperinflation is right around the corner. Yet at the same time, the increase in the money supply has been so extreme over the last year that I don't think inflation levels can be maintained at just 1 or 2%. In my opinion, the most likely outcome is a boom in American economy once lockdown fully subsides and pent-up demand is let loose, which will drive inflation as high as 5 or 6% a year. But I think it's very unlikely it will go any higher than, say, 8 or 9%, and the prospect of hyperinflation is basically impossible. If you like this video, be sure to subscribe, so I'm going to be putting up 3 or 4 videos every week just like this one. And if you made it to the end of the video, I'd just like to say thank you and ask what sort of content you'd like to see from this channel. If you could let me know if I should be making in-depth videos like this, or maybe tackling things a bit more surface level, that would be brilliant. Thanks for watching, until next time.